Facebook, Twitter, and in person. Welcome again for the this Monday before Thanksgiving. Getting excited here, so let's get started. Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I will be your host, and today I'm joined with my good friend Phil Weiss. Hey, Phil.
Hey, Kirk, how are you today?
Doing well. Doing well. Happy to have you with us here in this Monday before Thanksgiving. You got any plans?
Yeah, we have a big family thing. We'll be going up to New Jersey where my wife's family is from.
Nice. Nice. Yeah, I'm staying local here. I like to not travel on the busiest travel day of the year. I don't want to contribute to the congestion and all the confusion. Just want to let everybody know I'm mindful of everybody else's feelings that I don't want to travel and make it worse. Mostly for myself, but that's okay. You guys benefit too.
Well, we'll leave on Thursday morning because it's like a 3-hour drive and we'll get there and not hit traffic that way. So we'll avoid the rush.
Yeah, that's a good idea. My kids get out. One gets out Tuesday, one gets out Wednesday. I like the Tuesday idea. You can leave extra early. One more day with family is always a good thing, right?
Absolutely. My son is working in Seattle came home on Saturday, and he's going to be here for 2 weeks. So it was really nice at the dinner table last night. The first time since he left, we had all 6 of us sitting at the table together. It's always a nice thing.
Nice. That's awesome. That's awesome. My kids are still forced to sit at the dinner table with us, so we'll see if they stick around after when they have a choice. But for right now, they're there.
Yeah, I feel privileged that they still come.
Yeah, yeah. They only want to stick around for 10 minutes. They want to eat and leave. And I'm like, come on, it's Thanksgiving. Just sit there and talk to us for a few minutes. Oh boy, it's a good age. It's a good age. At least when you're driving them to sporting events, they can't leave. You have to have a conversation. You can't go anywhere.
I hear you.
Fortunate that they're playing sports. All right, well, let's dive right in. So, this is a short week, and it's interesting. There's a bunch of stuff I want to talk about today. As we're getting close to the end of the year, I want to talk about some financial stuff. Also, want to talk about what's going on in the markets. Because this session's called "Where Have All the Sellers Gone?" and rightfully so. Don't know where they are, but they're certainly not in the markets. So I want to start with this one question from a listener. His name's John, and it's a lengthy response, so I'm going to abbreviate it. So apologies, John, but to get the high points. Love the show. Avid listener. Haven't missed an episode since I started listening before the beginning of the year. My question revolves around stabilizing debt and how to do it. So I agree, this market, the Fed may or may not succeed in a soft landing. I do believe the government's debt could spiral the country into a bad recession if something isn't done soon or something other to kick the can down the road. Why doesn't this country just put the question out there and ask the brightest minds in the industry for ideas? Would it create too much turmoil in the market? I know politicians can't afford to look stupid, yada, yada. Basically just, asking communal help. This has gotten so bad, our government system, that the real risk is being ignored. Inverted yield curve, high rates, interest rates, high American personal debt, savings accounts dwindling, constant government downgrades. I believe something's going to give, and I'm like you, I just don't know what. Great question, John. Thank you for the contribution, and certainly recommend listeners send them in. Love these kind of questions because this really gets to the heart of what's going on. Okay, we talk about this all the time in the show, but I think I wanted to bring out this question specifically because it addresses certain things. So everyone thinks that the government debt is going to cause things to get out of control, and at some point it will. Here's the problem. Let's look at it from two different lenses, right? Because I know a lot of people are out there, they're like, get rid of the Fed, end the Fed, or like, I want more money. Give me my free Trump bucks or my Biden bucks, or give me my free dollars. And there's two sides of the equation, right? So if you think about most of society, right now, people are struggling. They're just starting to struggle. Like I've started to see the anecdotal stuff come out. It's going to get worse next year. So you're going to start to see more and more of this. So high interest rates are part of it, but there's a lot more to it. So one of the problems is you have one segment of society, which is the largest, by the way. So don't get me wrong. The largest segment of society is the poorest. I mean poorest, I don't mean you're on welfare. I mean, there's only a certain percentage of people on welfare, but poor meaning like you're able to pay your bills, but just barely. You're quote unquote middle class, but you're probably spending more. You're getting more in debt than you're earning. So your numbers aren't lining up the way you want. You're accustomed to a certain quality of living, and now that your credit card debts went from 6% up to 30%, you're struggling more, right? So all these aspects that rising interest rates have affected are causing people in the middle class, I use in air quotes, to struggle a lot more, right? Because they're able to balance, but now they can't because of interest rates. So on the one side, you have a big segment of society saying, I need a bailout, I need free money, I need help. On the other segment of society, you have people like, I don't need help, screw you, right? And I'm not saying they all think that way, but you have this balance, right? And I'm going to paraphrase this, but somebody said a long time ago, he said, well, the society only stays together long enough until they realize that they can vote themselves a portion of the public treasury, and that's when the public finances get out of control, which people have realized. So, but think of it this way, right? We've started down a path which started in like right around the 80s, where we started to leverage our economy. Lower rates, lower tax rates. People borrowed more. There's more facilitation of debt. And we had this debt expansion, which allowed the economy's size to expand, right? So if I have $100 and I can borrow $1,000, well, now my money ecosystem's not $100. Now my money ecosystem's $1,100. I can spend a lot more. But it doesn't mean, but that's debt, right? The $1,000 is just debt, which means at some point I have to pay it back. But I can still borrow that, which means that I can spend $200, $300, $400, up to $1,100. Now, at some point that gets paid back, which means that earnings doesn't get spent and it just goes to pay down debt. So debt is basically future earnings pulled forward into today. Now, what some people will do, the smart ones, is they'll buy real estate and they'll take out debt, and the real estate is used to pay off the debt. That's smart, right? That's a business function, right? It's like a corporation saying, I'm going to borrow $1 million so I can go out and grow, $3 million of additional revenue. That's a good use of debt, right? But a personal use of debt is when you borrow money that just means you have to pay it back later. It's like, oh, I'm just going to go buy these nice shoes. Just means you can't buy nice things for the next 3 months because you have to pay off the debt for the shoes, right? Because you wanted them today instead of saving the money. So that's how debt works, right? Now, our government, in its infinite wisdom, has decided to leverage itself up over the last few decades. And the problem is the more you leverage, the more you have to leverage. So as long as the economy grows, you can afford to expand the debt because the economy can sustain it, because the income coming in can be sustained by the debt, right? Or the debt can be sustained by the income, the tax revenues. So as long as we're growing, then we can keep expanding the debt to a certain degree. Now, if you have 0% interest rates, I forget what the treasuries got down to, 1.5, 1.3 or something, the 30 years, a few years ago, like a crazy low. And I think Janet Yellen should be drawn and quartered and hanged and burned and tarred and feathered and all of it. She's the worst. Let's just say she's probably the worst person ever to do this role. We had a chance to extend 30-year treasuries at like 1.5%. Now they're up to like, what, 5? We can't extend it. We could have extended out 30 years our debt problems. She should be, she should be tortured in front of the town square for the lack of foresight in doing this. Would she think it was going to get to 0? It's ridiculous. So the point being is we had a chance to extend our problems 30 years and we didn't. That's a treasonous offense, in my opinion. But that being said, stupidity aside, it didn't happen. But now we've got 30-year treasuries, I forget, they're 5% or low, high 4s, something like that. But anyway, they're at a place where we can't do that as easily. So we have a debt problem that's not going away. And unless we go into a massive recession where interest rates go back down to 0, we can't extend that debt out. So it's going to roll forward and we're going to have to pay it back in basically from our tax dollars that come in. So, long-winded way to say we have a debt problem. Everyone knows it. And the problem isn't that people aren't smart. Everyone knows what the problem is and people know what the solution is. It's not a secret. So John talked about, well, we should just, put the question out there and ask the brightest minds. You don't need that. The brightest minds have already answered, and no one is listening because it's not expedient. So we've passed the point of no return on some of these things. Pensions in general have passed the point of return. They're not getting paid back. They're going to go bankrupt at some point unless they're bailed out. Social Security, Medicare, both past the point of no return. They can be extended, but they can't be solved at this point. That problem is past unless you get rid of them. So there's a lot of aspects of our financial situation which have are past the point of no return. So you can't solve them. Math says you can't solve them. You can extend them. You can make them easier. You can't solve them, assuming that the benefits are still in place, right? You get rid of Social Security, of course, then the problem's solved. But they're never going to do that because every politician will be, tortured in the town square with Janet Yellen. So you can't necessarily solve the problem. So people say end the Fed. I'm in total agreement. It's a bunch of buffoonery going on where you have a handful of people trying to direct the economy, which is best directed by the populace, not a handful of people. However, it exists, right? I'm just stating the fact. You don't have to agree with me. You don't have to like the Fed. I don't like the Fed. That's not the point. But it exists. So how do you solve the problem? I don't know that the problem can be solved, right? You can't get rid of the Fed because what's going to go in that void? Something has to happen. It means that markets are going to go into disaster mode and they're going to implode and it's going to cause a whole bunch of problems because we're so reliant on the Fed. It's not because they're good, it's because we're reliant upon them and their word to say what's happening. And if that doesn't happen, something will fill the void. And in this day and age, I don't trust the solution to that problem any more than I do the Fed. So I'm not sure that the problem is easily solvable. My solution, which I proposed in 2008, was a debt jubilee. Debt jubilee, wipe out the debt across the world because every country has the same problem. Wipe across the board, get rid of all debt, which of course is not a solution, necessarily a great solution, but it is a solution that would reset the system and allow us to do it right. The problem is people just leverage up again and go at it. So I'm not saying that it's the best solution, but it is a solution, right? And so you have to think about like, how are we going to solve this? I don't know. I don't know there's a solution. Kick the can is the easiest one at this point, which is, so you shouldn't think about it as we need to solve this problem. It's not going to be solved. So the solutions are just as bad as the problem, right? So just understand that. So what is the best solution at the time? Kick the can. And that's what people are doing. So they're kicking the can down the road in hopes that at some point we grow at a massive degree where this is all irrelevant. But the problem with the math with the debt is in order to get the same impact that they get today, they have to borrow more and more and more. So the debt keeps doubling every 8 to 10 years. Well, as long as the economy doubles, it's great, but it's not. So that's where the problem comes in. That's where we become Japan, and the problems get worse. And Japan is in a precarious situation right now, and I don't know how long that'll last, but people have been saying that for 20 years too, and they're still going. So I don't want to necessarily characterize Japan as terminal, but the problem is not going to solve itself over there either. So I think if anything goes, they're going to go first because their math is much, much worse than everybody else's, and I think it's only a matter of time before their system has further problems. So, so John, I love your question. I love your thinking. It's a great way to think about it. I will say a great mental model to use is any problem our country has or society has, the best mental model is small experiments. Detroit has a problem because it looks like it was bombed in like a Hiroshima blew up there. Was that disastrous? You can buy properties for $100. Okay, how are we going to solve this? Well, obviously the current situation isn't solving it. Whatever they're doing now isn't working. So why don't we try mini experiments? Let's try this. Let's try this. You try take a section of it and let's try this. See what happens. Try this. See what happens. I mean, it can't get much worse, I suppose. So try little experiments. So I think in our country, socially, economically, culturally, it doesn't hurt to do mini experiments. Like, oh, you're afraid of nuclear reactors living in that area. Great, let's find a way to solve that. I've heard a few people come up with solutions to solve it. But the point is you don't solve it with a massive push out for everybody and you force everybody to do it. You just start small. If it works, expand, do more, expand more, and then be like, hey, this really works. Okay, now you can push it out because we know it works, right? So Opportunity zones are a good example. They tried it small, bipartisan agreement. Started small. Okay, it's working. Okay, great. Then they're talking about expanding on that now. Let's do more of it, right? That's a great example of starting small. So John, to your point, that is a great way to fix problems. Awesome way to fix problems. Is it going to fix the big problem? It's kind of hard to fix the debt problem. It's kind of a national problem, so I'm not sure if you could. You could try, but I think the problem is there's no appetite for solving it because the solution is worse than the current state, and everyone wouldn't get reelected, and no politician wants to you know get kicked out in their term. So I think that's more the reality than anything else. Is you don't have the you need to have the populace and massive agreement that we're going to do this. The Japanese were able to do this. Their culture was such that they said we're all going to take it on the chin. Instead of layoffs, like in this country, they just fire a bunch of people. In Japan, they said we're not going to fire anybody in the recession. We're going to all accept 5% less this year in income. Next year, we're going to accept 3% less. And they all did that as a culture. So as a culture, they accepted it. And they were able to do, that's why they're able to sustain their economy for so long, even though they're massively in debt, is because culturally they've in mass have accepted certain things for the betterment of the whole. They're able to do that. We're not. It's not the basis of our culture. We would never accept that. So it's not really a great solution for us because as a culture, as an economy, as a people, we wouldn't do it. So I think that's the problem. Is it has to be accepted. It has to go along with human nature, and human nature is it's not the problem. It's just something you just have to accept as it is, and you can't do things that you want to happen. You have to do things that are in line with human nature that will be acceptable to people, and I think that's really the solution. So, anyway, thank you, John, for the email. It was a wonderful thought, and we'll keep harping on this. Keep sending in your emails and let us know. Phil, I don't want to monopolize everything. What's on your mind? I got plenty to talk about. Let's give you a chance.
I think one of the first things I'd like to bring up is we're coming on the end of the year. Taxes are an important thing. Like I tell people, taxes and investing are joined at the hip because you got to take taxes into consideration when you're investing it. They matter a lot. Believe it or not, taxes are probably the biggest expense you're going to have during your lifetime. And most of us, we wait to think about taxes when January and February come. We start to get these things in the mail telling us about all the income we earned. At that point, it's too late. So you want to start to think about taxes ahead of time. It's November. We only have a month left in the year, but even November is better than waiting until January, February and just putting it off. Because the goal here is to try to lower your lifetime tax bill, not just the tax bill in any one year. So if you take that lifetime perspective, it can really make a big difference. And that's something that I work with people on a lot. So let's talk about a few things that we can do. First of all, we have tax advantage retirement accounts, IRAs, 401ks, things like that. If you're making contributions to those and you're eligible to them, make sure you max out. If you have the capability, max out, take as much as you can. You have to decide if it should be in a Roth where you don't get a tax deduction currently versus a regular IRA where you do get a tax break currently, but try to max those accounts out if you can. Look at what your tax bracket is. Like if I think of where the tax brackets are right now, we have a 10% bracket, we have a 12% bracket, we have a 22% bracket, we have a 24, then we go up to 32. And you want to pay, those rates are historically low. And if you get back to what Kirk was just talking about, like what are the odds that tax rates go down in the future? The current tax rates that we have, they're only going to be in place till 2025. The end of 2025, they go away. If they don't do anything else, we go back to the system we had before, which is the 2017 system, which is higher rates. So take advantage of these low rates. Look at what tax bracket you're in. I like to think about it. If you're in the 22 or 24% bracket, fill those brackets up. That means if you have money in a Roth, if you have money in an IRA or if you have money in a 401k, you can do a Roth conversion for some of it, do it because you're going to pay a lower rate now than you're probably going to pay in the future. It can also be a way to keep your Medicare premiums down in the future too, because the more your income is, the higher potentially your Medicare payments can become when you start to have to pay that. Another thing that we want to think about is if you're supposed to take required minimum distributions, make sure you do because there's penalties if you don't. And some things that you can do to reduce them. If you're 70 and a half, you can make a qualified charitable distribution. That means the money comes right out of your IRA and goes right to the charity. It doesn't enter your income. So that means that deductions like medical expenses, which are tied to your income, you can help keep add to the amount that you can deduct because you're going to keep your income down. You can also, again, I talked about Medicare. Like if I make those qualified charitable distributions, the money doesn't go into income. That means that it also protects me from having to pay more for what's called the income related monthly adjustment amount, or IRMA. If you have an inherited IRA and it's post 2020, the IRS has been really unclear about what to do in terms of taking distributions. They told us we have to have 10 years to take the money out. Everybody thought that meant you could wait till year 10 if you wanted. Then the IRS said, nope, that's not right. They put out proposed regulations that you have to take out every year, but they keep telling you don't have to take it. They keep forgiving you taking it. Maybe they'll put regulations out that we'll have to start taking them out in 2024. But I have clients who have those inherited IRAs now, and we've looked at, does it make sense to take something out now because you don't want to end up with this big amount left at the end, and then you're going to pay a much higher tax rate. So those are things that matter. If you have this, we've had uneven markets this year. You probably have some losers in your portfolio. If it's taxable, consider harvesting some of those losses, taking them. You can deduct up to $3,000 of capital losses in any year. And if you have more than that, they carry forward forever. Also, though, look at your capital gains rate. If you're a married couple and your income is under $89,500, you can take capital gains up to bring your income up to $89,500 and pay zero tax on them. So think about things like that too. So that's called, instead of tax loss harvesting, that's tax gain harvesting. That's another thing we want to think about. We also don't want to pay or tip the IRS, right? So if you're not employed, you're retired, or you're getting money from other sources, you have your own business, make sure you make your estimated tax payments. Because if you don't pay in enough during the year, you're going to owe the IRS interest. You're giving the IRS money you don't have to. We don't really want to get too big a refund either, because that's giving the IRS our money for free. But think about making your estimated payments during the year. If you have enough that you can afford it, think about making some gifts. This year, you can give $17,000 per person. So if a couple can give $34,000 to each of their children or to somebody else, give some taxable gifts or some tax-free gifts. You don't even have to file a tax return if you keep it under that 17 or 34. Give it to your kids if you're in that position. They're in a lower tax bracket. It also takes it out of your estate, and the estate tax exemption, which is really high right now, could go down too. So if you have a big enough estate, that's something else to consider. If you have mutual funds, they're dangerous when they're in taxable accounts. Why? Because unlike ETFs, mutual funds have to distribute their capital gains to the shareholders. So it's going to come middle of December. You're going to get a letter. You got a big capital gains distribution. I have one client that I have, they had over $300,000 of capital gains distributions last year. They weren't our client last year. As we're looking at this year, we're figuring out how much they can take in capital gains this year by selling some of those funds, pulling down those distributions, because those are things, even when you're working, they can force you to have to make quarterly estimated payments. Then also, if you're charitably inclined, think about some ways to make your charitable giving more tax efficient. I talked about qualified charitable distributions. Also, if you have appreciated stock you have a gain on in a taxable account, you can give that stock away. You get a deduction for the fair market value of the stock, and you don't have to pay tax on what you gave away. That's another thing that we can do. Also think about when you're taking your assets, if you have multiple accounts from a tax treatment perspective, think about which accounts belong in which assets belong in which type of account. Those are all things that we can think about to help lower our lifetime tax bill.
Awesome. Well, appreciate that, Phil. That's a lot. So I think that's very helpful this time of year. I think, as Phil said, it's a great time of year to be reviewing your tax planning. And typically, we work with accountants to do this time of year. I think it's a great time to do it. I will tell you that most accountants will not proactively do this for you. I know it's shocking, but most accountants will not proactively do this for you. So if your accountant's not doing it for you, you should ask. If it's too much for them, just send us an email. We got plenty of people who are very proactive that we work with that will take care of you. But generally speaking, it's something that you have to ask, because most accountants are busy this time of year and they just don't have the capacity to proactively do it. So, not placing blame, just telling you how it is. So just be aware. If you want to do tax planning, then you should take control of it. Or if you have a financial advisor who's good at it, like Phil or myself or someone else, then you could talk to them too. So anyway, but let's dive in. I want to talk about this chart. I've gotten this chart about 10 times in the last week. And for those of you who are listening, I'm going to explain it. This is a chart of renting versus buying. Now, years ago, maybe 10 plus years ago, I did a three set a blog post, which is broken into three parts because of three separate topics. And the idea was renting versus buying. Now, the funny thing is, most people look at renting versus buying. They're like, oh, yeah, it's just, it's better to buy. Not the case. It's not always better to buy. It can be, but not always. And so what I think people don't do is they don't actually do the math. Now, if you go to our website, there's actually a free calculator. You can do the math yourself, right? It's up there, so you can take it and do it. But the idea is you have to look at what's it going to cost me to rent, what's going to cost for me to buy, and which is the better choice. Now, many times people think, well, it's an investment. It's not an investment. Your home is a personal expense. It is not an investment. If you do the math, you realize what I did years ago. It is not an investment. Everyone will tell you it is. Don't believe them. Do the math yourself. You can come up with the answer. Now, I will tell you that there's a barrier in there that it's years ago, not necessarily now because the numbers are different, but years ago, the barrier was right around 750,000 in Massachusetts. Anything above 750,000 was cheaper to rent. Below that, it was cheaper to buy. So just understand, it's not just yes or no. It's also what price range is the market giving you. So if you look here in this chart, it is skyrocketing since 2020. 2020 was right around break even, and it's skyrocketed for the cost to buy. Now, this is what we've been talking about in the show for like the last year and a half, is how expensive it is to buy now in comparison to rent. Why would anybody buy? I don't know. You must have just obnoxious money to buy right now. It just doesn't make any sense. It makes so much more sense to rent. Now, I'm not saying you go out and sell all your stuff and rent. I'm just saying if you're in that consideration, if you're thinking of buying, consider renting for the time being. At some point, that will come back into balance and it'll make more sense to buy. But right now, it doesn't. And so I've had a few people say, "Oh, I was thinking of buying this." Don't buy it. It's just it's not even a close approximation. It is. If you go to the website, you'll see this chart. It is a difference between cost per rent is $1,800 a month. Cost to buy is about $2,700 a month. That's the difference for the same comparison. That's an enormous difference. I can't even begin to talk about how much of a difference that is. It's like 50%, somewhere thereabouts. So huge difference. So why would you do it? Well, typically when it spikes, it's when there's a bubble. So there was a bubble in 2006, a housing bubble. 2005, 6 is when it peaked and then dropped. And then it was a great time to buy around 2011, 12, 13. There was another bubble in the early 1980s, and then that eventually went down. So just understand that it does make sense to think about this in terms of economics. Now, it doesn't mean that other things aren't important. And I talk about this in the blog post. Like the numbers are the numbers. But the emotional aspect of owning versus renting is important, right? So I'm not going to discount emotions. Emotions are really important. Especially women, like women I know anyway. I'm not all women, but women I know, they have this like nesting feeling. Like they need to have some ownership, some sense of like I own this and this is mine, and I feel at home. Sometimes at renting, that feeling is not there. Some guys feel like I need to make this my own too. So I'm not making it about women, but it's just understand there's an emotional component of this, right? So, but right now, I mean, if you don't have to buy, don't buy. It is a crazy time to buy. I was looking at houses. I've said this before in the show in my area, and I was looking in a very far-reaching area because houses are a lot cheaper. But I was looking at the prices on Zillow. It just as a comparison, and there was one house. It was like 700, went between 650 and 750 for like 15 years. And all of a sudden, during COVID, it spiked up on Zillow. And then somebody listed it for sale for like 1.7 or 1.6. I was like, what? And this is given the fact that it's more expensive to get a mortgage, right? This person said, oh, well, I'm just going to see what I can get, see if some stupid person will buy it. Well, it was out there for a week, and then he dropped it 50,000. Next week, 50,000. So he keeps dropping it to see if there's some um, non-math person that wanted to buy the house. And so I think there's a lot of people just kind of trying to see what they can get. I think in the high end market, you probably get buyers because people just have money and they don't care. But for the most part, this is why houses aren't moving, because people can't afford to live there. I mean, if you could have afforded in 2020, $1,600 a month, you can't afford $2,700 a month. Maybe you can, but most people, that's too big of a jump. That means they're not buying clothes for their kids, or they're not heating their home, or whatever it is. Like, that's a big jump for some people. So just keep in mind how this is going to affect the economy and people in general. What are your thoughts, Phil?
So I want to take that from the other side for a second because I agree with what you're saying. But I have a client that I talked to the other day, and she said, "Should I sell my house or and move into a rental?" So when we talked about it, the value of her house she estimates is about $600,000. There's a place nearby that would meet her needs that she said she could rent it for $2,300 a month. So take the numbers, I multiply that's $27,600 to rent for the year. If she got $600,000 and we were able to just put it in, not that I recommend putting everything all into treasury bills or something like that, but if you look at where rates are right now, she could earn on that 600,000 just about what the cost of her rent is, and she would get rid of a $12,000 a year tax bill that she wouldn't have to pay if she rented, because she lives in Pennsylvania, property taxes are expensive. That expense would go away. She wouldn't have to worry about something breaking in the home or other repairs that are unexpected that result in a big cash outlay. So if you own, you could try to take advantage of this from the other way too. Does it make sense for you to continue to own? I know that, as Kirk said, there are emotional reasons, right? And if you have kids, it's really hard to uproot them and move them around and all that too. This person didn't have that. The biggest argument against it is that she's going to retire in a couple of years. And at retirement, she probably wants to be somebody else. So is it worth it to move now and then move again in 2 years? That might not make sense. But if I just look at the numbers, that's a case where if I think about it, it makes more sense, again, to rent than to own. But sell your house and use the money otherwise.
Yeah, so it's just I would say just be mindful of this, not just because of what it does, but also just the fact that how it's going to affect the country. And from the comment that John made earlier from his email of thinking that soft landing is a pipe dream, you know, everyone I know that knows what they're talking about. And I'm not saying that they're smarter than others. They're people who are at least informed of what's going on in the world. Um, they all kind of say the same thing, and I agree. Is that if the market has bounced from the October lows, and everything's sunshine and rainbows, everything's easy now. But this is typically the best time of the year on a strong presidential cycle, third year of the presidential cycle. So I'm not surprised. I wouldn't be surprised if the market takes off from here to the end of the year. If it does, I would be very, very negative on the market for next year. I think that's just setting the market up for a big sell-off next year. Um, I think the data is not showing that things are improving right now. The data is showing that things are deteriorating, and not to the degree that the Fed wants, but the Fed is looking to push us into a demand destruction or recession, and they're not quite getting that yet. So I think next year we're going to see some problems. Um, but if this year ends up kind of more moderated, then it's a crapshoot for next year. But if we end up on a high note, I think it's a great opportunity for next year to be really ugly. And I would just keep that in mind with how you're thinking about things. So I just kind of point that out. I will also point out this chart, which I thought was very interesting. I'll let Phil comment on it as well. So this is the chart. I'm trying to remember who does this. Crestmont Research. So this is a chart I've seen many, many, many times, and you probably have too. And this just shows the PE ratios in comparison. The change in the PE ratio is the red, and the blue lines are the PE ratio, I believe. Sorry, that's the rolling change in returns. So, what I want to point out is actually the lower part here. It's the bottom right, 20-year periods ending for like the last 140 years. And this shows decile of returns. And so I point this out because this is, you can look at this and say whether it's accurate or not. It's not the point. The point is if you look here in the top decile, decile one, which actually is inverted because decile one means the lowest, but um, decile one means that the average beginning PE, that's the price earnings ratio, the average beginning PE is 23.6. The number is 23.6. The average ending PE is 13.2. Now, the returns, the total returns ranges from 3% to 6%, on average around 5. Well, that's not very good, right? And so if you're, and this is for a 20-year period, by the way, not shorter. 20 years is a long time. What this means is that if you're starting out at a high point, you end up at a lower point and the returns are meager, right? Which is very similar to where we are now, right? I don't know, maybe Phil can fill me in, but I don't know where we are in the PE right now, but it's quite high. It's 20s, 23, 25, something like that. So the PE is quite high right now. So we're in pretty much decile one. But now if you look at decile 10, which is the most optimal, the average PE to start's around 10, and the average PE to end is around 28. So ideally, you start at a great point, and you end up at a most expensive point. Now, the range of returns is between 14% a year and 17% a year, average around 15.5. Now, what does this mean for you? What this means for you is if you're buying into a market or individual investments with a high PE, what that means is your future expectations of growth are small because the price has already elevated way above where the earnings are. It means that people have pulled forward future returns into today, right? So if you assume that a PE was 10 and you got 10% return a year, okay, we're balanced, right? PE of 23 means you're getting a 5%. Well, it's not balanced. So it just means that either A, you have to wait, I think it's like 20, 23 years to basically get the same amount of earnings. It's crazy, right? So you're much better off waiting till the PE is lower and then you invest. And at that point, your returns are much better. In this case, for the 10th decile, about 15.5%. So if you want 5% returns, invest today. If you want 15% returns, invest when the PE is lower. That's the message I'm trying to convey here. So what you should take away from this is that a lot of people are getting suckered into the market thinking, oh, it's going up, so I just need to stay in. I don't want to miss out, FOMO. I'd be very cautious right now about investing in the market. And this is not a binary yes or no. This is saying in or out. This is saying just be careful about your portfolio and your expectations of returns. Now, if you're okay waiting 20 years to get 5% returns a year, have at it. Go at it, right? Long term, go right ahead. But if you really want double digit returns over a 20-year period on an average, then you should probably be a little cautious here. That would be my recommendation. I think that, I don't know if it's this year, next year, year after. No, who knows? I mean, presidential elections next year. Who the hell knows who's going to win that? Who knows even if they're going to be alive to run? I mean, Biden versus Trump. They might even be alive by the end of the election season. They might be weekended at Biden's, with pulling Bernie up and trucking him around, or Trump, they got a little, dolly trucking him to events and, ventriloquist talking. Who the hell knows? I mean, this country's gotten so crazy. I mean, I saw the news Argentina. They just elected. What was the guy? Is the guy's a comedian, and his girlfriend's an impersonator, or I don't know what it is. I haven't read the news, but the point is everyone's shocked. Can you really be shocked at what's going on in Argentina nowadays? I'm not shocked at anything in Argentina. So maybe that's a good thing. Maybe we should elect a comedian too. Maybe we should elect an actor. I mean, maybe we should elect a rock or a dog. Why don't we elect a dog to president? Maybe they would do better than what we got in here now. So I don't know. I mean, the world's gotten so crazy. You feel like we're in Alice in Wonderland. We had that skit last few weeks ago in Alice in Wonderland. But anyway, point being is just be mindful of what you're doing now, where you're investing, how you're investing, and don't just jump in because things are going up. I think the reality is much more severe that if things are going up now and they keep going up, which they might, the next month is typically month and a half is typically the most positive times of the year. It might even go up to January. It might even go through January and start declining. February is typically the thing. So I'd be very cautious if that's the trend. Don't be afraid to ride it if you're momentum, but I'd be very cautious here. So, Phil, what are some final thoughts we get before we wrap it up?
So the point you're making about PE ratio is really important because there's really two ways that we get kind of growth when we invest. One is through growth in the PE ratio, and the other is through growth in earnings. Well, if we don't have a lot of growth in earnings, the PE ratio is not going to grow. When it gets really high and it's more likely to come down, that's going to hurt your earnings. So that chart showed it, right? Over the long term, investing when PE ratios are high is much more likely to result in lower returns. Doesn't mean you're going to get nothing, but it it does lead to lower returns because that PE ratio can't support it. The companies have to sometimes grow into their earnings, and if they're growing into their earnings, that means that their PE ratio is going to come down. So you can buy. There's companies that hit highs, their stock prices hit highs that they never get back to again. It's because there's so much optimism that sits around them that everybody wants to get in. There's FOMO. Like one of my favorite charts that kind of talks about this, like the cycle of market emotions, right? And it talks about how, we invest and we start to watch the market go up, and it's like a roller coaster, right? As it goes up, it goes like this, right? And then right around the peak, that's when we're most excited, and that's when we want to do more. And then it starts to go down, and then we start to get scared. And as it keeps going down more and more, we get scared. And when do we sell? Pretty much right at the bottom. So you got to pay attention. You got to pay attention to valuations. You got to pay attention to what's going on in the market. You don't want to jump in just because things have been going well, or because your friend told you about something that did well. They also didn't tell you about what didn't do well. So make your own decisions. And if you're not comfortable making your own decisions, find somebody that you're comfortable with that can help you make those decisions.
All right, where can people find more about you, Phil?
So I'm Phil Weiss. My firm is Apprise Wealth Management. I work with the women experiencing big life transitions. I know that can be stressful. My job is to help empower these women with the financial knowledge and tools they need to make self-assured decisions. My firm's Apprise Wealth Management. You can download my free ebook at apprisewealth.com/ebook, and you can also sign up for my blog. And if you go to my website, I talked about all those tax planning ideas. You can find a blog where I discuss them a little bit more as well. Thanks for having me, Kirk, and have a happy Thanksgiving. You and
Yeah,
all the listeners.
yeah. Thanks, Phil. Thanks for coming on, and have a happy Thanksgiving as well. I did want to share this picture of Meatloaf, or actually, this is the Libertarian Outsider, Javier Milei. I probably mispronounced that, but he was self-described anarcho-capitalist who just happens to look like Meatloaf, in my opinion. But anyway, I just wanted to share that because that was just a brilliant, brilliant picture. Anyway, so yeah, so we're gonna wrap it up in the spirit of Thanksgiving. We appreciate everybody listening to the show, and we try to give you our best every single week, and we certainly appreciate any sort of feedback, questions, ways that we can improve the show, because we want to make it better for you. That's why we're doing this. So that's the show for this week. Thank you again for joining us, Money Tree Investing Podcast. My name is Kirk Chisholm, wealth manager of Innovative Advisory Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast in the podcast app of your choosing. You can also check out the show at moneytreepodcast.com. On the website, you'll have access to the show notes, resources, and the archive shows. Also, we're now on YouTube. Please check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a show rating and comment on the podcast app of your choice. Oh, and don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send him an email and express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller, or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything. But I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do. So invest in your life.